the Applesway Investment Group that blew up. Major syndicator, lost more than 3,000 apartments in foreclosures. One of the most biggest commercial real estate blowups in the financial crisis. What my take on this article was what's great about it is it kind of personifies some of the easiest mistakes to avoid in syndications. I mean, and I'll throw them out, but to me, the three big mistakes that this group did is one, adjustable debt, which kind of goes to our whole topic, but they were using
Oh yeah.
adjustable rate, not fixed. They were taking on that interest rate risk, blew up in their face. Another one I just put out is just the sheer volume they were doing. I mean, we were really try to be selective in stuff we're doing. We don't just pick an asset class and try to manufacture as much product as we possibly can. And then the other one I throw out is the founder. Um, no knock on him, but um, he was an IT worker before getting into real estate. No real background before he started
Hold on.
structuring these investments. So I want to, you guys can throw out your other stuff, but the three to me was that jumped out was doing this with adjustable debt, not financially structuring this properly. Doing volume over selectivity, and then just not having experience or background in the industry you're operating in. But I'll kind of throw it out there for you guys to.
Well,
Yeah,
I was
Jeff
gonna
raised his
say,
hand first.
damn it.
It's like what is it? Steve, what's his name? The Family Feud, like who slaps down the buzzer quickest?
Oh, we got to see who's on the board.
Yeah, that's right.
All right, go ahead.
I'm gonna go like if we have that 10 topics up there on the Family Feud, I'm gonna go with number one, at least number two is they just didn't underwrite well enough. They didn't look
No, come on.
but
Come
well,
on. Steve and you and me, we know that the number one there is what his number three was. The guy started in IT and turned around the next day and bought 1,000 apartments with no experience of ever owning real estate before.
agreed. Look, I
So
mean, where I was gonna
underwriting
go
ties
is
right into that.
well, that was an easy segue, but the truth is you and I both know that the sheer magnitude of time it takes to underwrite deals, with us who have the experience, much less somebody who doesn't have the experience, you can't just AI your way into underwriting, some of this, it doesn't,
Thinking the same thing.
and by the way, you can try. Look, I tried to create a model with AI. It didn't work that way. It
I
basically
spent
told me
6
you're not
hours
good
working
enough.
on it. Yeah, me too. I spent 6 hours. Oh my God. That's another story for another time.
It kind of reminds me of that great Warren Buffett quote that when the tide goes out, you find out who's been swimming without swimsuits. I
That's
mean,
true.
while multifamily was doing great and stuff,
I think you mean
it
disintegrating swimsuits at this
yeah,
point.
well, it kind of goes to if you don't know what you're doing and the market's doing great, you don't necessarily notice it. But once you run in some difficulties, you start being able to really quickly tell who knew what they were doing and who was just kind of making it up as they went along.
Yeah,
Well,
I mean,
look, that's what you said no knock, and I agree, no knock. And that's what I go back and circle back to the no experience. And it's not no experience, right? Everyone has some experience to some degree, but going out and accumulating thousands of units at a time, you would know your first thing that you would want to do. This started about 4 years ago. So maybe in that first year, you would potentially look at some floating rate debt. But as far as I'm concerned, I would never look at pure floating rate. They make 5 and 5 where it's fixed for 5 years at a time before it changes. But that's something I learned from doing it for a while. The other side, with Jeff and what he was saying with underwriting, you have to see how those debt payments, those insurance payments, which again, another topic we don't want to discuss or broach today, could impact a property. That's something it sounds like was not done in this case. So when shit hits the fan, there is no safety net. There's no stress test. They just all fall out the bottom. I mean, you read that article, he sent out a report saying, oh, everything's going to be fine, don't worry about it. And then the next report was a special report right before the actual quarterly, where he's like, sorry, I gave it to the bank, we're in foreclosure. Like, I mean, there's just something there. You know, you get a little bit more time. You do this once or twice. You start with 1 or 2 before you buy 10. You learn a few things, you know, and you don't make some of those mistakes, and your investors don't pay for it. And that's how we came together. Is we went through all of that in our own respective careers, and it's not something we would ever do.
Yeah, and let's I'm going to take a step back and just for some of our listeners, just kind of explain duration risk in a really simple way. So let's imagine that we're a retiree on a fixed budget. We got a certain amount of money coming in Social Security. You know, maybe we got a pension, a certain amount of money coming in, and we're going to buy a house. And we can do that with a fixed interest rate. And we know we've got enough money coming in our pension, our Social Security to pay that mortgage. Or we could pay less with an adjustable rate, but the risk would be if interest rates go up, that adjustable could go up and it could potentially go up higher than what our pension or Social Security could cover. And that's essentially what happened here is they got the lower rate of an adjustable, but he took on the risk that those rates could go up higher than his ability to service the debt. And I would say that kind of going back to the experience thing, that's just an obvious thing you don't do. I mean, it's right. It's so obvious. I don't think we'd even consider doing it. It's just kind of crazy to put that kind of risk on when you don't need to with a fixed rate product to try to get that extra few percentage to pad things.
Would you walk into Vegas and bet on 00 on a roulette table and think you're going to win? Or would you know that the house is stacked against you if you do that? That's how I look at an adjustable rate mortgage to a certain degree.
Yeah, you're making an interest rate, but you're basically playing a bond trader. You're basically saying I'm making a bet that I know where interest rates are going to go in the future, and I'm going to try to pocket the spread on the adjustable versus the fixed.
Those guys get paid hundreds of millions of dollars a year and have billions of dollars of research behind them. Who do you think is going to know better?
Well, you add to it, and again, no judgment. There was probably some degree of just playing the cap rate, the cap rate side of this as well. You know, I bought this at a 5.5, and cap rates are trending towards 3s. Man, I'm going to make a lot of money on my, from 5.5 down to 4, maybe 3.5, somewhere in there when people are buying. Nobody's buying at 3s. Nobody's buying at 5s anymore. So he probably got compounded with the fact that he had the interest rates where they were going the opposite way and had cap rates going the opposite way. And in his mind, he probably went, oh shit, what do I do now?
Well, and I think, kind of like some of that time, I mean, we started talking about the commercial lending issues, some of the issue commercial banks are having. I mean, this really ties in. And honestly, I'm not a big fan of the Federal Reserve. I think they've botched a lot of things. I think it was a huge mistake taking the Fed funds rate to 0.25%, basically having free money and doing it for a while.
Hey, I liked free money. It was good.
Well, so did these guys, and so did a lot of other people. And I think that's the problem is people started to build business models built around very low interest rates and free money, and they built it around it wasn't going to change. The Fed would keep the spigots on, and that you whether it's FTX or whether it's Applesway or whether it was Silicon Valley Bank having a lot of short duration treasuries and not having enough longer duration that they got hit with this too.
Preminger? That's how
Why you got short duration treasuries?
I did.
No, I'm sorry. Yeah. No, I flipped that. Sorry. Silicon Valley Bank had too much in the way of long duration, not enough short. So, when the rates started going up, they were still holding that longer duration paper with the lower rates. But yeah, I think, all this stuff's interrelated. And you had a lot of business models, whether it was Silicon Valley Bank or whether it was Applesway, or whether it was FTX or a lot of players that were really built their business model around cheap money, low interest rates, and we're just seeing some of those players that didn't structure things properly blowing up.
That's what happened to me, and that's what I learned the hard way. Is I used adjustable on my first property that I purchased, rental, and got a run up and lost it. Well, I didn't lose it. I ended up selling it, but I didn't sell it for what I thought I was going to sell it for.
You mean you didn't
Anyway.
buy $100,000 property and sell it for $2.5 million?
Well, I mean, I have done that, but it was not in residential real estate. So,
Well,
Oh.
that's part of. I mean, that also gets back to our point about experience. I mean, part of experience is you've been doing this for a while. Earlier in your career, you might have made one or two mistakes and learned from them, and you've certainly, if you've been doing it for a while, you've seen plenty of other people make mistakes, and had the opportunity to learn from their mistakes too.
You mean like those too good to be true deals with like 40% return on investment?
Yeah, we
oh
won't.
God, yeah, no, love those. I'm still looking for one of those. If you guys ever find one, and I'll send my my money to the prince overseas. It's
I
fine.
was told they're all in development.
Ah, great.
Yeah, a few less of those nowadays, as we're seeing them blow up. Anyhow, that's what I've got in terms of news headlines for today. We'll get together, have a few drinks, and talk some other headlines soon. I'm sure it'll be more uplifting, bright news stories from the media we have to talk about.